Let's get into it. Let's rock and roll. The Fed speaks. It's literally Jerome Powell, chairman of the Federal Reserve, is bending himself into a pretzel verbally to do everything he can to get out of making any kind of call or inject any kind of ability to forecast interest rate policy, bending himself into a pretzel despite some of the best financial news media people in the business questioning him. The Fed announces it's going to do some massive bond sales, almost $800 billion over the next 2 months. And what happens? Interest rates go down because of incredibly strong demand from investors who are worried about a slowdown in the economy, possibly a recession, and who see yields on treasuries so attractive that they would rather be in those than they would be in stocks, in spite of stocks having higher long-term historical returns, albeit with lots of volatility. These are the things we're going to talk about. Stay tuned. We've got a good show today. Let's rock. All right, we're back. Thank you so much for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's my live stream every Monday through Thursday, not just about market updates and just the news, but it's giving you perspective. I've been doing this now for 34 years, and I've helped so many clients overcome obstacles and achieve financial goals. And I've seen people do this before they met me, and I learned from what they've done right. I learned from their mistakes, and you can learn from my mistakes too. So it's just like a big learning party. That's what this is, the learning show, right? So let's talk about the news. The Fed met today. They had their interest rate policy meeting. So when the Federal Reserve meets every 6 weeks, the group of Federal Reserve bankers and their staff that meet, it's called the Federal Open Markets Committee. This is the small group that votes on interest rate increases, decreases, or to keep them flat. They control short-term rates, and they do that through both the discount rate and the federal funds rate. The federal funds rate is the one that we talk about by far the most in the media. That's what we're going to continue to talk about now. The Fed raises short-term rates with the expectation that if rates go up, that means the cost of money goes up and things that are financed become more expensive. So imagine if you buy an item for $100,000 and you're paying $5,000 a year in interest. Now imagine paying $8,000 or $9,000 a year in interest. It means less money for other things because the cost of that debt, the cost of that borrowed money is higher. That's what we call interest rates, the cost of money. You could look at it in dollar terms, or you could look at it in interest rate terms. So the Fed met today, and during the presser, when Jerome Powell, chairman of the Federal Reserve, spoke, he is very cautious to not lock himself in to a commitment. Oh, you can't raise rates now because you said you wouldn't raise them. So if he raises rates, it's a hurt to his credibility. And in the world of finance, in the world of banking, credibility is your currency. It's that important. So he's not going to commit to saying the Fed is done raising rates. He's not going to commit to saying we could raise more. That's why he's very careful to say every Fed meeting, every 6 weeks is a live meeting, which means they could raise rates or they could leave them steady. Raising rates would be a live meeting, I guess, right? Right. So every 6 weeks, that is what they're going to do. They're going to keep it as a live meeting without telling you what their direction is going to be. And a lot of things that investors go by, like something called the Fed's dot plot and standard metrics that we measure the economy by are not really helping. And there's a few reasons for that. It's because the economy is different today than it was 30 years ago. It's different because the demographics of our country has changed in the last couple of decades, meaning there's more older people, there's more people retired, fewer people working. And there's a whole bunch of things that are starting to make us question the Fed's old orthodoxy in terms of what's important and what's not. And we're all trying to figure out our way through this. In the meantime, the Fed has raised rates from near zero to between 5.25% to 5.5% on the federal funds rate. And it's taking a long time for the economy to feel it. But now the thinking is maybe the economy just won't feel higher rates the way it used to. Or maybe when consumers finally run out of all of their cash from stimulus from the COVID, the pandemic, that's when they'll run into trouble. Or maybe they already are because consumers are borrowing more on their credit cards. College debt continues to rise. Automobiles are more expensive than they've ever been. So auto debt is going up. Debt, that's going up across the board. And what about all the commercial real estate mortgages that have to be refinanced over the next few years, which are going to be refinanced at higher rates? So many things going on. Now we could talk a little bit about the stock market. Stock market, as measured by the Dow Jones, the S&P, the Nasdaq, the Russell 2000 small cap index. These major benchmarks were down for the last 3 months in a row. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. But investors are getting pretty fed up and they're starting to worry, especially if you're getting close to retirement or if you're in retirement, because you have a tendency to say, this is what I have. If I divide it by, let's say, 30 years, then divide that, by 12, that's what I get every month. So if the market goes down and I have less money, I have less money to spend. I have less money to live my life. And with inflation, it's even less buying power. I advise people not to think that way because what we expect is your investments over time to grow over decades, over many years. This is why we preach long-term investing, not short-term investing. And this is why we say bull markets and bear markets, the cycles are not really the thing that's going to impact your ability to retire. It's your own personal finance. If you're spending more than you should, there's nothing that you can do about that. You can't invest your way out of poor savings and spending habits. It's like dieting. You can't outrun a bad diet. And it's the same thing in finance. So having said that, the Fed pointed out a couple of things, that the labor participation rate is up more than he expected, and which is a positive. It's a supply side economics factor, but so more people coming to the labor market, and that makes sense. Okay, it makes sense for two reasons. Number one, people are getting paid more to work. Number two, people have to work because of inflation. The money that they had just isn't going as far as it once did. So people are joining the labor force. So that could help alleviate a labor shortage. A couple of other things he said is that because interest rates have been elevated, I'm talking long-term rates, that is helping to make money tight. It's helping the Fed do its job instead of the Fed doing all the work and raising rates. The free market's raising rates, watching the 2-year bond, the 10-year bond reach 5%. Until today, that is, because just when you think rates have to go higher, they go down. That's what's so confounding about the markets, stock and bond markets. So let's take a look at the day's action. I'm going to put a few things up on my screen. I'm going to make my screen a little bigger so you can see it. By the way, if you have any questions, if you want to ask me something, please do so in the comments. Okay. And words of wisdom, words of encouragement are always appreciated as well. So let's take a look at the screen that I have up. Okay. So the Dow up, it was up over 500 points on Monday. It was up over 100 yesterday. It's up over 200 today. This is shaping up to be a good week, and November is getting off. Well, it's only November 1st, so I guess you could say November's off to a good start because if you stop the month now, it's like saying the Mets are in first place after winning their first game. Let's end the season, okay? All right, so the Dow up 220, Nasdaq up 210. That's a pretty big day, up 1.6%. S&P up over 1%. Gold coming down a little bit. Just doesn't seem to be able to hold $2,000 an ounce. I really don't see what the utility is with gold anymore, but that's me right now. Okay. Oil down to $80 a barrel. We were just talking, not you and I, pundits were saying this could go a lot higher. And I've been saying, as you know, because you watch the show, that if the global economy is slowing down and you're worried about global economy weakening and too much debt and all these things, that's a negative for oil. Oil prices would go down. There's plenty of oil. And there's some shifts. Certain countries stop selling to certain countries. There's sanctions, and then the countries get around it by selling to other countries. The oil is moving around. It's all being pumped. It's all being sold. It's just that different people are buying oil from different countries. And in the meantime, the U.S. is the biggest oil driller and the biggest oil producer in the world now. The U.S. 10-year yield, the ever-important bond yield, which hit 5% last week and shook the market for the last couple of weeks because it hit 5% 2 weeks ago as well. Now it's below 4.75%. Just when you thought that could only go higher, it's down. We're going to talk more about that. The VIX is down to the 16s. People are feeling a lot calmer, okay? News, Solar Edge sinks 24% after company offers weak guidance. Okay, so a couple of things in the last 3 months. It's the artificial intelligence boom has worn off. That lifted stocks so much. Solar/green energy stocks have come down. EV stocks, which were supposed to be all the rage, turns out EV stocks are getting killed right now, and auto dealers are holding on. I read an article today. Auto dealers, electric battery-operated cars are sitting on lots for 100 plus days, and there's 100 days worth of supply versus only 52-day supply for combustion engines. News from Toyota, who deliberately bet that there's more than one way to succeed than EVs, and they said it's up to the local market to determine if EVs, ICE, meaning internal combustion engines, or hybrids are the way to go. And Toyota is cleaning up with good earnings and raising guidance because of hybrid sales, which is pretty cool. I have a Toyota hybrid myself, and I love my car, and I get really good gas mileage. Okay, having said that, the bonds. So why were bonds, let me put this up on the screen. Why were yields down? Because if you look at the news, okay, Secretary details plans to step up size of bond sales to manage growing debt load and higher rates. And yet, bond yields are down across the board. The 2-year is under 5. Remember what I always say, right? 2-year yield under 5%, stocks rally. So the 10-year yield is under 5% again, well under 5%. And the difference between the 2-year and the 10-year is very slight, which means the yield curve is still inverted, but by very little. We could see a flat yield curve pretty soon. We'll talk more about what that means in the near term. TLT is the ETF. It's a well-known ETF from iShares for 20-year plus Treasury bonds. So Treasury bonds that mature in 20 years plus. This, in the last couple of years, is down like 40%. But let me just get to the year to date. Year to date, it's down 14.5%. It's trading like a lousy stock, isn't it? Right? It's more like a stock. Okay, but there is right now a record amount of money for this fund going into it. It's why. Here's what I want to reinforce. Remember, I said at the top of the show that investors are interested in bonds for a couple of reasons. Better yields, which means less reliance on the stock market. Remember, a couple of years ago, people were buying dividend stocks, saying, consumer staples dividend stocks like Kellogg's and McDonald's and General Mills and other stocks. There who were buying it for the dividend, saying, we don't care about the valuations. We just care that they have a dividend. It's a good name. Those stocks are all down. They're hitting year lows. Maybe they're bouncing off a little bit, but they're pretty close to lows. We look at these all the time, okay? Yeah, but they had dividends. Well, now you're losing a lot of principal. So great, you had a 3% dividend yield, but if you lose 30% of your equity, that means you only lost 27%. Do you feel better now? No. So these are the things we look at. And yeah. So there's demand for bonds. You could buy, you were getting up until recently 5% plus on 2-year treasuries. Not a bad place to be for 2 years. And if your bogey of a return is 7%, let's say, to make your dreams come true in your financial plan, you had to rely much less on stocks than on bonds. We talked about 10-year zero coupon treasury bonds. We talked about a lot of these things. Interest rates could still move higher yet. But the way I look at these is if your bogey for the fixed income portion, for the fixed income allocation of your portfolio is 5%, and you can get 5% from a treasury bill, then that's your deal. It's not a matter of, well, maybe I'll wait because next week maybe I'll get 5.1 or 5.2%. When you see the yield that's right for you, you take it. This is not a matter of timing. We don't believe in timing interest rates. It's even harder to time interest rates than it is to time the stock market. But if you see the right yield for you, and we know what the right yield is for our clients, and that's why we act accordingly, okay? Hopefully you're doing that. By the way, if you want to reach out to me directly, check out Client First Strategy. You see my information in the ticker below, clientfirststrategy.com, or call 631-920-6624. We can have a chat to see if we're a good fit, to see if we should be managing your portfolio and helping you develop your financial plan. And what else? Just a bit of record keeping before I go. This is pretty significant because it affects a lot of people. The IRS announces 2024 retirement account contribution limits. So for 401ks, it's going from $22,500. It's going from $22,500 in 2023 to $23,000 for 2024, and IRAs are going from $6,500 to $7,000. The catch-up contribution is still $1,000 for the IRA for people 50 and over. The catch-up contribution for 401ks for people who are 50 and over is still $7,500. But if you're making money, you can afford to put some money away. The limits that you could put away just got a little bit bigger. Not terrible news for investors, okay? That's about it. Thank you for watching. I will see you tomorrow, and I hope you enjoyed the show. And if you watch this in the replay, look, these shows are always on my timeline, so you can always check them out later. I would love for you to watch these even, at a time that's more convenient for you. Hit me with your comments with your questions, and I will be more than happy to answer them. Have a great day. Thank you.